found a couple of option strategies I think is worthwhile showing. So just here's this the schematic. On the right, I put in the call, like, bullish, so it's green, and then the bearish, like the put, is red, and then the yellow is added all together. So let's start with straddles. You long a call and short long a call and a put at the same strike price. So you long a call and then short a put, and then at the time of expiration, your payout gonna be like this. Meaning if it's remember, like in the expiration for all of those things, you sell the options. If they expire out of the money, you earn the premium. If you buy something, if it go out of the money, you pay for a premium. So buying something, long something, you need to pay, so drift it down. If you sell something, it's drifted up. We'll exercise it later, but imagine, so this it's not like no matter what you earn money, you lose some money if it is expire like too close to the strike price. So it's pretty much, this straddle is to profit from high volatility, and the strangle is just similar to straddle, but with this bigger spread of call and put. It's of course cheaper because at the current price, at the spot price, the call and put will be cheaper out of the money. So yeah, that's that. Iron Condor is a little bit complicated, and I hope my chalk is. I saw the chalk might not be too clear, but I will try to make sense of it. You long the put, the green line, long the put, and then short a put, and then short a call, and then long the call. The four different strike price. So adding all of them together, you can imagine here, here, and here, and here. So since your short selling thinks that it's closer to the current stock price, like a spot price, these are a little bit more expensive than those two. So this whole thing gonna shift up, if it makes sense. It will shift up profiting from the short selling, because those two options are more expensive than those two. So this is profiting from pretty much the stock stay within this range. If it stays within this range, you earn money. So it's our convention. C is call, and P is put, and there's a sub indices because there's so many things together. So S stands for short, and L stands for long. And bull call spread. So pretty much you long the call, long the call, short the call, short the call. So pretty much long the call looks like that, shorting the call looks like this. So you have this curve for this for the eventual payout, and it's usually cheaper because you earn some money from this. So this is almost to a degree somewhat synthesizing, right? Yeah, I wouldn't say that, but yeah, and the bear put, it just is almost a symmetry of what a bear call spread is. You short a put and then long the put, so you will have a limited earning, but it will be cheaper. for you to have this bearish position. It's not very clear because it's very. So just a notation, when I do another shorter call, it is orange, and then shorter put is like a darker green. So butterfly spread is a little bit more complicated. Long the call, short a call, and then long another call. So you add them all together. It's almost we'll talk about that later. So it's butterfly spread, similar things. You're profiting from low volatility. So this is low volatility. This is profiting from high volatility. This is from low volatility. Anyway, and there you have it. And then let's go to the next board. Cover call. Just a convention. The purple is a stock. You long a stock. So cover call is you long a stock, and then out of the you sell a call usually out of the money. But if you think the stock going to go down, you can long a little bit close enough out of money. But so pretty much your payout is you're gonna lose money at this until your strike price. So pretty much you earn a little bit extra while holding the stock from the premium of the option. So yeah, and protective put, similar idea to this. You hold a stock and you protect yourself from the extreme downside just by a put option that pretty much at this strike price you wouldn't have an infinite you wouldn't have additional losses because the put kicks in. But yeah, you have, so pretty much you just protect yourself against the downside with of course the insurance, the premium of the put. And the caller, you have underlying stock, you long a put, and then you short a call. So it ended up getting some sort of spread. So limiting the upside and limiting the downside. So it's almost like a hybrid of those two things. So you can you're limiting the upside with potential profiting from selling the short option, selling the call option, and you limit the downside by buying a put option. And calendar spread is you buy options. It's not necessarily call; it could be put. You can buy call or put option at different times, and then you can profiting from the changing of volatility and the time decay. The butterfly is a little bit more complicated. You long a call, and then you buy you pretty much short a straddle. So in the sense you just sell a straddle. You have you short a put, and then short a call, and lastly long a put. So the eventual payout looks like this. Keep in mind, as we mentioned before, the long call, the long call is cheaper than the short selling at the money, at the spot. So this whole graph will shift up because you have additional profit from short selling. So essentially, it will look like something like this, in the sense that you will profiting from low volatility. If it stay within the range of the short selling, you will come with a profit. And that's all of the option strategies that I can find. So you have straddle, strangle. So pretty much a lot of them is like protecting you for the downside, profiting from high volatility, low volatility, and then getting an option that is slightly cheaper than the normal call option or put option, and profiting from time decay, and selling, getting some premium from holding the stock, and the protecting the downside. And yeah, that's all.